Welcome to Value Vest Daily. Today, we are diving deep into a company that has been an absolute rocket ship in the ad tech world. We're talking about AppLovin, ticker symbol APP. This company has been putting up some truly mind-boggling numbers. So let's get right into it and see what all the hype is about. Just look at that number, 118% growth, and that's just year to date. When you see performance like this, you have to ask the big questions. What in the world is fueling this thing? And more importantly, how much higher can it actually go? So, let's start by unpacking that explosive growth story. A surge like this doesn't just happen out of nowhere. It's built on a foundation of some seriously powerful fundamentals. And, you guessed it, some major AI tailwinds that are completely changing the game in advertising. So, a few key things are creating the perfect storm here for AppLovin. First, they launched a self-serve platform that just made everything easier and cheaper for developers to jump on board. At the same time, their AI is just feasting on this booming $100 billion mobile ad market. That led to a ridiculous 68% year-over-year revenue jump in Q3. And they're not even stopping there. They're making smart moves into streaming TV with their acquisition of World. Okay, that brings us to their core advantage, what I like to call their unbeatable AI moat. The numbers are incredible, sure, but it's the technology behind those numbers that could make AppLovin a real long-term titan. This is the why. This is the secret sauce. So what does AppLovin actually do? Well, think of it as a one-stop shop for mobile app developers. They help with two huge things. App discovery helps them find new users, and their Max Tech helps them squeeze every last penny out of their ads. But the real magic, the engine driving this whole machine, is their incredible AI called AXON.
And let's put AXON's power into perspective here. I mean, you put it head-to-head with a behemoth like Meta's Advantage Plus AI, and you know what? AppLovin is actually winning where it counts for its customers. We're seeing a 45% higher return on ad spend. That is huge. It means for every dollar you put in, you get 45% more back. So while Meta is great for just getting your name out there, AppLovin's AXON is like a sniper rifle, delivering way better results for performance-focused advertisers.
You know, I absolutely love this analogy. It just nails their business model. They're not just another player selling tools in the gold rush. No. They own the whole operation, the mines, the railroads, the refinery. They control the entire process from start to finish, and that gives them an unbelievable competitive advantage. And you can see that strength clear as day in the numbers. Look at the competition. You've got Unity, you've got The Trade Desk, both respectable companies. But AppLovin isn't just bigger. Its growth is more than double its closest competitor. It's not just playing in the same league, it's actively pulling away from the pack. All right, let's get into the financials, because a great story is one thing, right? But a great story that's backed by some truly elite numbers, well, that's where you find the real game-changing opportunities.
Let's just start with this monster number, a return on equity of over 241%. That is just wild. What ROE tells us is how good a company is at making money from its shareholders' cash. A number this high basically screams that management is operating at an absolutely elite level of efficiency.
And that efficiency just keeps on coming. A profit margin of nearly 45%. In the cutthroat ad tech space, that is a phenomenal figure. It really cements AppLovin's status as the king of profitability in this arena. And check this out. This isn't some one-hit wonder. We're talking about a 94% compound annual growth rate in their software revenue over the last 5 years. That shows a consistent, explosive, and proven track record. This company was literally built for speed. Okay, let's quickly break down the key stats. Yeah, that trailing PE of 81 looks pricey. You are definitely paying a premium for this kind of growth. But look at the forward PE. It's a much more reasonable 47. Now, the one number you got to watch, the potential yellow flag, is that debt-to-equity ratio. At over 238%, that's pretty high. It means they're using a lot of leverage, which adds a layer of risk we need to be aware of. So, where's this all going? Well, if you listen to the analysts, they see this train continuing to roll. The projections suggest AppLovin's market cap could more than double by 2030, smashing through that $500 billion mark. This just gives you a great visual of the kind of massive long-term upsides we could be looking at. All right, so we've established the fundamental picture is incredibly strong. Now, let's switch gears and talk about the technicals. The long-term story looks great, but what are the charts telling us right now? Is this a clear entry point? And this really is the million-dollar question, isn't it? After a crazy run like this, 8 straight days up, has the train already left the station? Or is this thing just getting warmed up? Let's see what the data says. So the technical picture is screaming momentum. You can see the stock is trading way above all its key moving averages, the 20, the 50, and the 200-day. For traders, that is a classic textbook bullish signal. And the RSI, the Relative Strength Index, is at 69. That shows strong buying pressure, but it's not quite in that overbought territory yet, which could mean there's still some room to run.
And who's doing all this buying? Check this out. Nearly 83% of the company is owned by big institutions. This is not just a retail-driven fad. This is the smart money. We're talking huge funds and investment banks piling into this stock. That adds a massive layer of conviction to the whole bull thesis.
All right, let's put a bow on this. We've looked at the explosive growth, the AI moat, the rock-solid financials, and the bullish technicals. Now, let's bring it all together for a final verdict. What's the real upside, and what are the risks? Analysts are definitely seeing some serious upside here. The average target for the next year is around $711. But the long-term bull case, that's where things get really wild. Some analysts see the stock hitting nearly $4,000 by 2030. Now, for that to happen, a lot has to go right, but it shows you the potential. We're talking a possible 3 to 5 times your money from where it is today. But hey, we have to be real here. No investment is a sure thing. As we talked about, that high debt is a big one to watch. The premium valuation means this stock could get slammed if growth slows even a little bit. And of course, if the whole economy goes into a recession, ad spending is one of the first things to get cut. Finally, with a beta of over 2.5, this thing is volatile. It's going to have big swings, so you need real conviction to hold it. Make sure you position your size accordingly.
And we have to say it. This is not financial advice. This explainer is for informational and educational purposes only. You should always do your own research before making any investment decisions. If you found this deep dive valuable, do us a huge favor and hit that subscribe button, give us a like, and share it. Our whole goal here at ValueVest Daily is to bring you totally unbiased opportunities to learn about before you put your hard-earned money to work.
Hey, one more thing before you go. We really want to hear from you. What ticker symbol should we break down next? Drop it in the comments below and let us know. Thanks for tuning in.